Welcome back to the What's More podcast. I'm your host, Quinton Harris. You dialed in for episode 215. And hey, what are we going to talk about this? We're going to talk about why will the Fed cut rates nearly 200 basis points? Not a matter of if, but when. And how long is it going to take? All that and more in this episode at What's Your One More. Okay, so welcome back. You know, the Federal Reserve Open Market Committee just met, and it was almost like a flyby. Like no one really paid attention to it because it kind of got lost in the luster and the allure of what happened with the election. It kind of was swept under the rug. And like I said in one of our previous episodes, like normally we would dedicate an entire, Super Bowl week to a Fed meeting, especially when we got a rate cut. And this one just, I don't want to say fell on deaf ears, but there was a lot of positive in this that kind of got overshadowed by the election. And I kind of want to dig into it because to me, it told a lot of telling signs of what 2025 is going to look like. And I thought there was some good tongue-in-cheek banter from Powell on this. And you really haven't seen this side of him. And I think it's kind of a turning point, and I'm going to explain why as we get into that. So by now, as you're hearing this, the Federal Reserve reduced the Fed funds rate 25 basis points. And I think that was a foregone conclusion. Everyone knew it was going to happen. There was no signaling of anything different. All signs pointed towards that. So it was kind of uneventful. That's kind of what I'm trying to say here. But what was interesting to me was that I think heading into December, there was this ideology that they may pause, especially with the election and not knowing the results. And even with the results, there may be a pause. But I think the CPI that came out yesterday, this episode is being recorded on Thursday the 14th. CPI came out yesterday, the 13th. And I think there's this ideology that, hey, listen, this is probably going to see another cut in December, along with some of the comments from Powell. But with the CPI, what happened is that it came in line. And so when we look at expectations, which we've talked about in multiple episodes, if the markets are expecting a 0.3 reading on the month, and it comes in at 0.3, that's a win for the markets, right? Because they anticipated that, they expected it. If it came in higher, that's when volatility is created. In this particular instance, it came in slightly lower, around 0.28, but we round up in the economic world, we round up. So they rounded up to 0.3, but the reality was it came in lower. And then if you go dive into the core CPI, that's still got a 2 handle on it. And if you remove the shelter component, which we talked about shelter being housing, we've talked about what's going on with housing between rents and housing and the price of that, we know they're still elevated. If you remove that, you're looking at a 2.1 CPI handle. And what's interesting about that is even though the Federal Reserve doesn't use the CPI as their favorite form of inflation, they use the core PCE, they're still very aware of it. And we're going to get into that a little bit later on in the episode. But what I want to talk about was this. Let's kick it off with the commentary from Powell at the podium. And I thought this was really important because he made 2 key acknowledgments at that podium that we've been dying to hear from him. Like it's been, are we going on 28 months now? Maybe not 28. Let's say 24. It's been a long time, let's say that. We've been waiting on Powell to acknowledge a couple of things that kind of can make me feel a little bit more comfortable as a mortgage professional, as a real estate investor, if I'm a real estate agent, a buyer or seller. Let's listen up here because this is where it's going to get really good because we've been waiting on this. He first said that the Fed is finally acknowledging and admitting that they're tracking and watching the 3-month and the 6-month core PCE. Now, we've been screaming for that on this show for quite some time. Why is it important they would look at a 3-month snapshot and a 6-month snapshot versus the whole 12-month running average? Well, the reason for that is this. What happened in the rearview mirror isn't nearly as important as what's happening right in front of us. And so, our friend Barry Habib uses the analogy the Fed's been driving a car while looking in the rearview mirror instead of the front windshield. And I can agree with him and totally see where he's coming from because they're using lagging data to support their policy right now. Well, the quickest way to correct that is look at the most recent data. And that's what Powell acknowledged they're doing. So when they look at a 90-day average of the core PCE and they look at the 6-month average of the core PCE, what they're finding is that, to Powell's own admittance, it's much closer to the target rate of the 2% inflation they've been trying to tackle. It's like, well, hey, ding, 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 where have we been? That's what we've been saying. There's been multiple people, multiple pundits screaming that, including us from this show, that we're already there. That being restrictive as long as they were was not good. And while he didn't say it wasn't good, he did say, we're not really too concerned with inflation. I mean, we think we're targeting and we're on track to be exactly where we want to get at our 2%. And if you look at the 3 to 6 months, which he said we're tracking at 3 to 6 months, we're pretty much there. And by pretty much, it's like 2.3. It's really close there. He also said this. He said, and I think this was the big win of the conversation, the Federal Reserve feels that the 6-month core PCE is the closer rate to neutral. Now, that's a really important comment. And for our listeners, what I want to mean by that, or what I want to get to and kind of explain is this. A neutral rate versus a restrictive rate is really important because neutral means you're not restricting the monetary supply and you're not restricting other wins by having more money in the system or just being neutral. More people will borrow at neutral than they will at restrictive. More businesses will borrow and flourish at neutral than they will at restrictive. The economy should be in neutral, not restrictive. So it's very important that, and for this piece of the conversation, we define what that neutral means. Well, the interesting part was he said, we feel like the 6-month core PCE, is more of a neutral territory, more of a neutral rate. Well, if that's at 2.3, and as we're making this podcast, the current Fed funds rate is at 4.5 and 4.75. If it's in between there, so let's say 4.625 for the conversation, you're anywhere from 220 to 245 basis points off of neutral right now. So he just told us that we think that's closer to neutral, and they want to get to neutral, by the way. He also said we want to get to neutral. So coming out of restrictive territory, getting to neutral means you're going to have to make at least 200 plus basis points cut. Now, while I don't think next meeting or the meeting after that, they're going to do 100 or 150 or whatever it takes, I think what he did, though, was open it up to every meeting here on out is going to be a rate cut. The question is how much? Is it going to be a quarter? Is it going to be 50? Are we going to get 75? But they're coming. So now it's up to the markets to anticipate what these are going to be. And I think over the course of the next really 6 weeks, leading into the new year, that's when all of the new forecasts are going to come out of, hey, this meeting cut will be 50, 75, and here's why. I think what's interesting about this is the question is, the billion-dollar question, I guess you could say, is how long is it going to take to get to neutral? Well, how long is it going to take to get to this? Is it going to take the entire year of 2025 and into the first quarter of 26? You get 8 meetings a year. So if you did 8 meetings at a quarter each meeting, you do the math, that's 200 basis points. So they could slow walk this thing all the way down. And there's a lot of arguments as to why that would be healthy for the economy. And then there's a lot of arguments as to, hey, if you want to jumpstart the economy, if you want to really get that thing going, let's do a bigger basis cut, reduction here, not hike. Let's do a bigger reduction and really get this thing going. And I think at the end of the day, while we know Powell does not answer to an administration, and I've gone and I've harped on this numerous episodes, I think their concern is with the health of the markets. I think their concern is with the stability of the markets. And the last thing they want to do is shock Wall Street. That's the last thing they want to do. As much as they claim that they're not there for that, I think they're very aware of that. And you could even argue maybe because they're financially dependent and involved in that, and maybe so. But I would say that their overall stance would be not to shock the market there. So I think there's 3 incentives I think the Federal Reserve has right now to get that rate down. So when we talk about the core reading, we talk about how long, I want to tell you why I think it'll be quicker in 25 than it will be to a duration of 26. There's 3 incentives. 3 major ones, and the first 2 are way more important than the last one here. But the first one, as I was saying, was to appease the markets, right? The equities market. Let's don't be fooled. The Fed is not going to do anything to shock that market because if they do, then they've got a real problem on their hands. Cheap money will fuel the market, right? Cheap money intoxicates the market. We've seen that happen during the zero interest rate policy, and by no means are we going to get to a ZERP policy, but getting back to neutral is going to be a lot better than being at this elevated 4+, 4.5. Heck, we were even at 5 recently into that Fed funds rate. It's going to be a lot better than that. So that cheaper money will intoxicate the market. What I mean by that is the market will thrive by saying, hey, listen, it's cheaper to borrow money at this rate. We can create more products, more facilities, hire more jobs, more profits. You get the point. The markets thrive on that, which is why you see some of the quick gains we got here because there's ideology that Fed's going to lower the rates significantly over this time. The other thing is this: the lower the Fed funds rate, the lower the rate on the national debt. And that's important because the only way to kind of curtail that national debt is not to pay as much interest on it. I mean, we've done, again, numerous podcasts on this topic as well, but when the interest payment on the national debt is one of the top 3 largest expenses, and I think it just became number 2 largest expenses on the actual budget, that's a problem. So the only way to get that down and get that reduced is to lower these interest rates. And I do think they're motivated by that. I think this is where the administration becomes more motivated behind that, whether it was Biden or whether it was Trump or whether it would have been the Harris administration. It doesn't matter. I think all administrations were motivated to get that down. I think this is what you're going to see happen from the Federal Reserve. If some of the stuff we're talking about on the podcast interests you and you're like, hey, Q, I want to be a homeowner. I want to buy an investment property. I want strategies on how I can take advantage of the market. I have a solution for you. And that solution is Loan People, to where it's all about the people getting the loan and the people doing the loan. You guys know me by now. I've been doing this podcast for years, but I've been in the mortgage business for 23. And it's very rare you can find a company that has a mantra for loan officers, by loan officers. And what does that mean? That means you have a company that's designed to help provide the best atmosphere for loan officers possibly imagined. And not only that, the most efficient operations for those loan officers to be successful, which provides a better customer service. And that's what you get at Loan People. So much so that they put that in the company name. And at the heart of this is the people. It's in-house processing, it's underwriting, it's closing and funding. And why choose them? They got great rates. They close on time and they have award-winning service. So check them out at loanpeoplejax.com. That's loanpeoplejax.com. And I think the third and final one is this. And it might be a distant third, but it's still on the board. And I'll tell you this, because affordability is an issue. Now, while Jerome Powell said, hey, listen, we are not making policies to appease the housing market. We are not here to influence transactions and increase refinances and purchases. That's not what our policies dictate. They are very aware of what's going on in the housing market. And what I mean by that is this. If the Fed is concerned about the labor market, and we know they are, because right now they've already kind of over the last couple of meetings disclosed that they're okay with inflation the way it is. Like if you remember, the whole start of this 26 months ago is we have two mandates. We're going to go tackle inflation at 2%. We have a target rate inflation, and then the labor market, right? And so right now they've already acknowledged inflation's where it needs to be for their comfort level. The labor market, however, is still in question. They've made multiple comments that they will be watching that. They'll be looking at the continuing jobs claims report on a weekly basis, and they'll be looking at jobless claims weekly that come out. And they're going to be looking at the BLS, and they'll be looking at the ADP numbers as they come through, even though, again, we've talked about how those really aren't as dependent as they should be. They're still reviewing these things. And so here's a track that I know they're taking heavy consideration on. If you look at home builders in the United States, it's very difficult for them to make the kind of profit they want to make at this elevated interest rate of 6.5 to 7.5 range. And we've been living in that range for quite some time. There's no denial of that. In some cases, we were in the 8s, but we've been living in that range. It is difficult for them to want to go vertical and build more homes as a builder at that rate and move the product and still make the profit they want to make, especially these publicly traded builders on a home. So what have they been doing to keep the transactions going? Well, there's a couple things that have been happening. Number one, they aren't building as many as they once were when rates were lower. They're just not. And number two is they're doing everything they can to subsidize that rate or incentivize that transaction. And you know what I'm talking about. If you stepped into a new build community, again, especially the publicly traded ones, the Lennar, the DHIs, DR Hortons, the larger ones, Toll Brothers, list goes on and on. You've got them in your area. If you stepped into any of these, and I know I'm leaving a bunch out, there's a ton of them, whatever, I can go on and on. There's a heavy incentive on there. In some cases, it may be in the form of $50,000 worth of upgrades. It may be in closing costs. It may be in getting this rate down into the 4s or even the 3.99s that you're seeing on some of these flyers. Well, they're doing that to hold the line on that purchase price. Because one thing is not happening is you're not seeing a reduction in the purchase price. Now, ask yourself that question. Why are we not seeing that? Well, I'll tell you why. Because in 2008, I think the builders still have those same financial scars as the people that lived through it. And I think they go, listen, the worst thing we can do right now is reduce prices of the home. Because once they start doing reductions, that is a snowball effect. Because here's what happens. If you're a builder, the last thing you want to do is reduce the price of the home. Because typically, you're not building one home at a time. In a community, you're building multiple homes in multiple different phases, right? So if I lower the price of one home when a new contract is signed, maybe that's in phase 1. And maybe I've got 4 or 5 homes in phase 1. And I lowered the price for all 4 or 5 homes in phase 1 because I needed to get those purchase contracts signed. Let's assume that happens. Let's say that home was selling at $500,000 and I lowered it to $480,000 and 4 people signed contracts. But in phase 2 were people that signed contracts 60 days ago. And phase 3 were people that signed contract 120 days ago. You get the point. And in both phase 2 and 3, those prices are $500,000. Maybe there are more. Don't think for a minute that builder is not going to have to answer to those people in phase 2 and 3 about why they lowered that price. Because where are those people in phase 2 and 3? They're not in the home yet. They haven't bought it. They haven't closed on it. What do you think they're going to do? And they will find out. What do you think they're going to do? They're going to come back to the builder and go, hey, why did they get 480 and why am I paying 500? And that the builder does not want to have that conversation. They do not want to go through that because that is how contracts fall out. That is how issues start to happen. And it's a chaos that's created. So they will protect that purchase price at all costs, even to the cost of profit, even to the cost of incentives to get that deal done. And they're fighting affordability just like the rest of us. So to get people in the home, they are paying thousands of dollars towards the interest rate to get the payment in line for the buyer. But they're keeping that price at the same price as it was 3, 4, 5, 6 months ago because they're not going to drop those prices. They're not going to do it. So where I'm going with that and the Federal Reserve is this. If they're not building as many homes as they once were, they're slowing down the actual build out, right? And we know that's happening. We can look around. We've seen all the reports. We know it. They're slowing down production because the rate environment is not, it's not beneficial for them right now. And the affordability is not beneficial for them right now. Let's don't get it twisted. Builders are not in the Red Cross. They are there to make a profit. And so they have to make a profit, right? That's part of being a business. So they're going to slow down production and they're going to make limited supply on that to get it done. Well, that means not as many construction workers, residential construction workers, are actually building those homes. And I think that's a labor pool. It's a labor force that I think is a byproduct of elevated rates that could see a significant fall off. And I think that is the first wave. And I'm not the only one that thinks this, but I think that's the first wave of a recession. When you see residential workers, residential construction workers, start to lose jobs or not be on the job, that is going to be your first sign of a recession. And I think what happens is that the Fed doesn't want that. And so they know that. So keeping these rates elevated actually de-incentivize builders to go out and build more homes. We're undersupplied significantly. We need to build more homes. So while the Fed is not there to bolster the real estate market, they are not there to say, hey, listen, we're here to make sure transactions get done, and we're here to make sure that everyone can get a home, and we're here to make sure that refinances can be done at lower rates so people can get a hold of their equity. That's not their position. Their position, though, is to tackle 2% inflation in the labor market. And they will look at the housing labor market, and they will look at the residential construction workers because they've already seen them evaporate on the commercial side. The last place they want to see them evaporate is on the residential side. And so I think that's that's a distant third, but I also think it's very important that get revealed here because I think that's something they're definitely taking a look at it. So I will say, if those rates come back down to even the 5s, I think you're going to see a lot more availability of products for the builders, a lot more availability of homes being built. And I think because the builder now is not having to sacrifice as much profit in the transaction to make sure the buyers are okay buying this home. And I think that's a big incentive for them to go out and say, all right, let's start building some more because they have the land already. They have the commitments out there. They literally have just said, we're going to slow it down. And a lot of that comes from caution from their days in 2008. And I don't blame them. I absolutely don't blame them. And so I think this is a very distant third, but I think it's in the conversation behind closed doors with the Federal Reserve. I also said this. I think that another interesting sign from Wednesday was, the CPI data, as I talked about. It came in line. It also said, hey, listen, we're not going backwards. We're actually maintaining or coming down. And I think that's important. Now, again, while they don't look at that, they being the Federal Reserve, they look at the PCE. I think the PCE is going to be mildly representative of the CPI in the form that it's going to be in line. I don't think it's going to be elevated, but you got to remember, even if it goes up just a slight bit like it did last month, we have room in that to still hold the 2 handle. And I think that's important. And I think that they've acknowledged, hey, we may see some rise and then some decline in the PCE, but we believe it's going to stay in line for the remainder of the year going into Q1. And so I think that they're very comfortable where it is right now. So last thing I want to talk about here was this, and you might want to Charlie cue up the old Leonardo DiCaprio, I'm not leaving comment, where he's jumping up and down from what is the Wolf of Wall Street and he beat his chest. I'm not leaving. That's kind of how I felt about Powell right here because he got the T-ball question, which was teed up. So are you gonna step down now that Trump's taking over office? And he's like, I'm not leaving. I am not going to do that. And I think the reporter in that question was trying to maybe bait him a little bit and get him to maybe shoot fireworks at what he believes or doesn't believe the policy is going to be or the pressure he's going to receive from the administration. But here's what it is. He was asked about stepping down or getting fired, and he said that's absolutely not going to happen, and that I can't be fired. And he's right. Technically, he can't be fired. He cannot. there's a way for him to be removed. I think that it would go through a judicial system, and it would take a lot more than just the president removing him. I don't think that can happen, but there is a loophole in the system, and I know that he would fight it tooth and nail, and that's why it will never happen. But there is that. But let's just say that's not going to happen. His term's up in 2026, so at that point, that's when the president will have a choice: keep him or remove him. And let's don't kid ourselves. I mean, Powell was appointed by Trump. And he was put in there by Trump. They butted heads a little bit while he was in there. And then Trump started getting what he wanted from Powell, which was lowering of interest rates. And then COVID hit and all bets were off. What happened at that point? Trump was out of office. He was super critical of Powell while he wasn't in office. So I guess where I'm going with that is there's really this love-hate relationship there that's been aired out through the media quite a bit. It'll be interesting to see if he stays in there through 2026 and beyond. I think all of that depends on what happens in 2025. And I think that Powell's very aware of that. And I also believe that the Federal Reserve has already acknowledged that these cuts are coming. So I guess where I'm going with that is I think you're going to see these cuts all through 2025 before 2026. And I think that the ideology of a quarter through 8 months is going to get you to 200 basis points by the end of the year. I think we may see some quarters and some 50s, not going to be 100s. And the only thing that can break that, the only thing that can change that dynamic is the labor market. If we start seeing signs of the labor market weakening, you can bet that 200 basis points is going to be cut much quicker than the duration of 2025, the whole year. You might see it in 2 meetings you might see it in 3 meetings, one versus all 8. If this labor market turns for the worse, if it continues to be resilient and shows signs of just continuity, it's going to be a quarter all the way through the year. That's what you're going to get. And so I go back to the beginning of this podcast, when I said, hey, Powell signaling the 6-month core PCE is a sign of neutral, and neutral's at 2.3 right now. Excuse me, core 6-month PCE is 2.3, which is what they'd be at neutral. That's 220 to 245 basis points from where we're currently at right now. That's a big difference. So the question becomes, what side of the fence are you on? Do you see the labor market deteriorating? Do you see the labor market staying consistent? It's probably not going to improve. So the quicker it deteriorates, the faster these rate cuts come. I'm not cheering for a labor market crash. That's not what I'm saying. I'm just saying if that happens, the faster this comes, and the more it stays consistent and resilient, the longer the duration it is. So depends on what side of the fence you're on. That's when you're going to get your rate cuts. Guys, if you like what you're hearing, please tune into our YouTube channel at What's Your One More with the number one. Share our podcast at Apple, Spotify, Amazon. We're on all major podcast platforms. And make sure you leave us some comments. We love what we were hearing. That episode we did with our guest, Lenny Curry, you guys left a lot of great comments on there about the discussion and breakdown of the new administration and the housing policies on that. We greatly appreciate it. So, guys, thanks again for tuning in. We'll see you the next episode at What's Your One More.
Got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.